You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from OptionAlpha.com, working every single week to make this the most popular investing podcast offered online because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So again, thank you so much for tuning into today's show. Today's show, number 144, we bring in a very special interview guest in Larry Connors, and we talk about his new book, Buy the Fear and Sell the Greed, which I think is a great book, something you should definitely pick up, and we'll talk about it in depth here on today's podcast. Now, I want to give you a little bit of background to how this all came about and some of the things that we're going to be discussing in the interview before we bring Larry on, because I think it'll be interesting to set the context and help you understand what we're going to be talking about during our time together. Now, you guys know from listening, or those of you who have listened to me for a long time, know that I don't just bring in anybody to get on the podcast. I consider this relationship between me and you to be a very valuable relationship, and I don't want anybody getting in the way of that unless I think they truly add value. That's why I don't, fill my shows with a bunch of interviews of people just because they want to be on our show. In this case, I wanted to get Larry on the show because I had a chance to read the book, and I do read a lot of books that are out there, and I think his approach to how he looks at trading in a very systematic fashion matches very well to what we try to do as options traders. And I think there's a lot of synergies here that we can learn from together, and it's just another way for you to understand how markets work and the dynamics behind markets. So before I bring Larry on, just so you guys know who Larry Connors is, he's definitely one of the authorities, I think, in the options and systematic trading space. He's been authored or has authored 7 books, including The Wall Street Smart Sheets with Market Wizards legend Linda. Street Smarts was selected as the Technical Analysis in Stock magazine as one of the classic books of the 20th century. So this, and as well as the new one, which we're going to be talking about here, Buy the Fear and Sell the Greed, I think are very good books, something you should definitely pick up and take a look at. Now, in the interview today, I asked Larry about his history in trading, how he kind of got into it, how he got his start, his whole path. We talk about this bond trader story, which I think is an insanely cool story, talking about Marko Kolanovic, which is a huge asset manager, and how he was talking about how the markets would totally reverse course and it would be, death on Wall Street, black swan events during this Brexit, and it ended up being something totally different. So we talk about a trading opportunity through that. We talk about VIX pricing and how you can use VIX to your advantage if you are a shorter of VIX premium. Also, how you can take advantage of the VIX pricing and how you can use options to your advantage with the option strategies you could potentially use around VIX or VXX trading. So we talk about that. We also talk about why he says this is the golden age of options trading. That's not my quote, that's his. He says it's the golden age of options trading. And then we finish out with a lot of discussion on automation, the future of trading, where technology is going, how that's going to change or evolve as we, understand more about how computers are going to interact. And does this basically eliminate this emotional, fearful, greedy dynamic that happens in the market right now? So it was a really, really interesting discussion. I hope you guys really enjoy it. And as always, if you guys have any questions at all, please let us know. Head on over to the show notes page at optionalpha.com/show 144. All right, so let's bring Larry in. All right. Hey, Larry, thanks so much for joining us today. How are you doing?
Good, and thank you for having me, Kirk. I'm a subscriber to your podcast and very much enjoy it, so I'm happy to be here.
Nice. Awesome, man. I appreciate it. Very nice. So, hey, well, let's get started here. Just hear a little bit about you, maybe a couple minutes on just quickly hearing about your background, where you came from, how you got into trading, what your path has been, I guess, in this business, and then we'll go from there.
I was, even as a child, I had some stocks. My grandfather used to give it to me for my birthday, so I was able to track the markets. But I began trading more so in college, which was in the late 70s and very early 80s. I ran a couple businesses while I was in college. I've always worked a few jobs and took some of that cash, found my way into, at the time it was penny stock trading out of the Denver Stock Exchange, which is no longer relevant. Probably as a lot of people went through, I was fortunate enough to enter at the time of a bubble and really got a chance to see just how quickly money can be made and then eventually lost from bubbles. It was a very good lesson, but I was off and running from there. Came out of college, got hired by Merrill Lynch, went through their training program, which was tremendous. So I was basically 13 years on the sell side. I finished up at Donaldson, Lufkin, and Jenrette. So I basically viewed Merrill Lynch as my undergraduate degree in the markets, and DLJ was my graduate degree. 1994, I got to the point where I was ready to trade on my own. I had hoped to have been there in 1987. I was married, had our first child, who's now my oldest. But it took 7 years. It took from 87 to 94 to really get to the point of saying, okay, can I make a steady living doing this? And for those of you who are out there who go back, you'll know that there was a limited amount of information available for people to learn how to trade. Professional traders did not share information back then. So very much a learning curve from 87 to 94. But by 94, I was pretty confident that I would be able to take care of my family. We lived a good lifestyle. We lived in Malibu, California, across the street from the beach. It was a comfortable lifestyle, somewhat of a big risk at the time, only being 34 years old doing it, but it worked. It basically, there were enough inefficiencies in the marketplace back there in the 90s that it allowed us to be able to go in, learn how to trade the markets, and been able to continue to do so in one way, not only on the trading side, but also on the research side, sharing the research side. I've been able to do it now for 24 years.
Wow. And it's impressive. And I know you've written a lot of books, which we talked about earlier. So the one that we're going to talk about today is, I guess, your newest one, which is the Buy the Fear, Sell the Greed, 7 Behavioral Quant Strategies for Traders. And so I said this already in the intro, but I read the book completely, start to finish. I think it was a great book. And what I love about it is the quant focus, the focus on also the psychology of, market participants, this, ebb and flow between greed and fear that we see all the time. So let's start with the greed and fear side. So inside the book, you said, fear is hardwired into humans. So let's kind of elaborate on this, like the backstop of what everything is, behind these strategies. And that is this concept that people become very fearful and then they become greedy and it just sways back and forth, right?
Yes. And this is not only in the trading world. I mean, this is hardwired. I'm not a medical doctor. I don't have a science background in this, but you see the science has shown this. Is that there's essentially 3 types of brains, and the lower brain is the fear brain. It's often referred to as the reptilian brain. And what happens is in times of great deal of stress, what happens is that kicks in, that part of the brain kicks in, people become irrational. That's gone on through history. That's been shown. Science has now taken it. It's been shown in MRIs that brains change, the structure of brains change when fear comes into place. And what eventually happens over there is that irrational decision making takes place, not only in the financial markets, but this is in all walks of life. The military has known about this for years. I opened up the book with a quote from, it was then Major George Patton, not General George Patton, it was Major George Patton that wrote about it in I believe it was in 1924, that the fear and emotion that's going to be felt by the soldiers today at that time was the same fear and emotion that was felt centuries before. And I used that quote intentionally. I read that quote probably 20 years ago, and I've kept that in front of me for all those years, because when you bring it into the marketplace, when basically there's a high level of fear in the marketplace, when things begin selling off, and now because of media and social media, it tends to be even more exaggerated. What happens is the edges appear, and those edges are behavioral edges and not edges that are being created in anything else that either the individual traders, now it's mostly, especially the active managers, they end up knee-jerking. And you could see this chapter after chapter in the book, and this is why we've quantified it. Many of the chapters are quantified back a quarter century. We've updated the test results up through last year. You see this continuous pattern of when fear comes into the marketplaces, edges appear. And what we do is we put rules around that, make sure that it's systematic, being able to historically test it. But yes, fear is the driving reason why these, at least in my opinion, why these edges have existed and will potentially exist, or at least that fear will exist for likely for our lifetime.
Yeah. And I think, so a couple key points that I took away from it was that, because fear is so hardwired into who we are, it's going to take centuries for it to become not hardwired. It's just part of our DNA. It's part of our anatomy. And
Yes.
one of the quotes I liked from the book is that you said, logical thinking is replaced by overwhelming emotions. And that's, I think, is important because, and correct me if I'm wrong, but it happens on both the retail level, which we all know about because we're all retail traders, right? And many people listening to this podcast are retail traders. But it also happens on the asset management level when you have asset managers who fear getting cut and fear a job loss. And so it's a different kind of fear. It's, do I want to be in this thing? Because if I'm not, if I'm in this thing and it goes down, I may not have a job next year, right? I may get replaced.
Yes. There's two sets of managers out there. There's the active managers who are really fighting, a tough battle out there, at least, on a public relations basis. And then there's the passive managers that are basically, they have no choice. If their investors are watching, hypothetically, not to pick on CNBC, but if they're watching CNBC and see that, markets are potentially going to sell off, there's all this panic that's been induced over there, they're going to liquidate positions. And that means money's going to flow out of those index funds. And that creates mispricings there. You've got a combination of the two. But you're absolutely right. It is done on a retail level, meaning on an individual basis. It's also done on a professional basis. It's all tied together.
Yeah, I think it's it. Well, because at the end of the day, guess what? Everyone's humans, right? Behind all these systems, eventually there's a human that coded it, that develops it, that, picks it. And I think that's where, the edge still lies. So as you go through the book, and this is good, and we'll have a link, just so you guys know, everyone who's listening to the show, we'll have a link in the show notes on the podcast. So you can just go to the show notes page. We'll have a link. I think it's tradingmarkets.com/buythefear if you want to pick up a copy of the book. So in there, you talked about a couple different strategies. We're only going to go through a couple of them because we don't have enough time to do all of them. I wish we could spend hours talking about them because I'd love to do that. But we'll kind of tease people a little bit with a couple of strategies. And the ones that, honestly, that I favored and I kind of like, I appreciate, I liked a little bit more. So the first one that we want to talk about is just a VIX panic strategy. And this one I like because it gets to a concept that we talked about a couple podcasts ago, which is how VIX is priced and how, I'm sorry, not VIX, VXX, how VXX is priced and how it's got this, continuous negative drag because of contango. So can you maybe kind of go through a little bit about, VIX pricing just briefly and why it's such a interesting product and yet still seems to climb in volume and activity, how we can potentially take advantage of it as a fear indicator?
Good place to start. So just people should know just a brief background of VXX. VXX was brought out in 2009 as a reaction to 2008. It was basically the market had the big market sell-off in 2008. And the VXX product was basically intended to be to protect portfolios. So it was done with good intentions. They built an instrument that basically was intended to be something that would protect you from, not you, but protecting traders and investors from market sell-offs. Okay, it basically was supposed to be long, and it is long VIX futures. Okay, good intention, maybe somewhat rushed to the market because of the timing. The demand was pretty great for it when it first came out. When it first came out, we probably looked at it like everyone else. It's like, wow, great idea, super. This is really conceptually looked like it was going to be something that was going to be a winner. Jump ahead a year, and even though the market rallied, but in VXX, I believe lost somewhere between 60 to 65% in a year. If you look ahead 3 years after they brought it public, you look ahead into 2011, it had lost over 90% of its value. And by the time 2013, 2014 came around, it was 99 point, it was over 99% of its value. Couple of reasons over there, and this is just a reminder that this is a structural inefficiency combined with a behavioral inefficiency, okay? So you already noted that VXX is structurally inefficient. One only has to look at the chart to see that where it's been, where it started as to where it is today. It's basically been built to go to zero. That has been written about a number of times. We wrote about it back in 2011, and it appeared like it was built to go to zero. Many others, back in 2010, 2011, were writing the same type of research articles. It was built unintentionally, and in my opinion, it was built to go to zero. So there's two structural aspects with VXX. Number one, contango. They're dealing with contango. What they're basically doing is they need to sell the front month futures options and buy the following months. And in most cases, over 80% of the time, they're selling low and buying high. And everyone who's on this podcast, we all know, we all trade, we all know that's not a good recipe.
It doesn't last long. Yeah, you run out of money quickly.
You really do. And number two, I think this is the part that people don't spend as much time on, but I think it's important to understand is that the underlying contract of VXX is of VIX futures, and VIX futures are insurance. Okay, what happens is that the VIX is purchased as portfolio insurance. That was the main intent of creating the VIX back in the late 80s and early 90s, and then ultimately bringing out the VIX futures. That's portfolio insurance. We all know that most, if not the overwhelming majority of insurance is overpriced. Okay, VIX as a whole has historically been overpriced since it was created. And the first quotes, for example, that we have for the VIX come out of Bloomberg back in 1992. If you measure the implied volatility of the market, okay, you look at the day-to-day implied volatility of the market, essentially what the market is implying for volatility versus its realized volatility, okay, what that gives you is a measurement. That measurement basically shows you that the implied volatility, meaning the price of insurance, has historically been overpriced to what realized volatility has been. I've seen different numbers over there. Our own numbers internally show that since 1992, approximately, it's north of 80% of the time, the implied volatility has been overpriced versus realized volatility. Said quicker, but this is overpriced. This is insurance. Insurance is overpriced.
Hey, it's the basis. I was going to say, I agree with you. We've done a bunch of research on it as well, which we posted on the website. It's a widely known fact. It's the basis of most of what we do for investing here. So
perfect. So when that baseline is in place, you get to see a structural inefficiency. You understand the structural inefficiency, and then from there, the behavioral component comes in. So what happens is that that VXX becomes this knee-jerk reaction, saying the somewhat uninformed money. I want to be careful here because I don't want to insult anyone, but somewhat the uninformed money is going to use and has used VXX as an instrument to protect the portfolios. And in spite of the fact that it's now been multiple years, I believe it's now in its ninth year of trading, it somewhat amazes me that the volume has continued to pick up. There has to be a buyer for every seller in these things. It's just it's lost now. It has lost over 99.99% of its value, and yet it still remains a vehicle that's gone to. Okay, if you asked me this back in 2011, if it was going to be around, I'd say maybe another year or two.
You say no way. Yeah, this thing's dying a slow death. Yeah,
absolutely. And Kurt, when we as we were doing it, we showed in the book the volume has not disappeared, has increased over the years on VXX. So it's here, and it's something to take it. Something that traders potentially can take advantage of.
Yeah, and so in the book you outline, and we don't have to go through all the specifics of it, but you basically outline a very simple VXX panic strategy where you're using some RSIs to basically scale into, and this is a point I wanted to kind of get to, was that scale into a position where you are, let's say, shorting VXX. Now, how we do that, or how we go about that, we can definitely talk about here in a little bit, but is the idea generally with VXX, I guess the easiest trade, if we want to just say it's the easiest trade, is to trade it short whenever it spikes and just have some way of determining when that entry trigger point is available.
Yes. I mean, there are certainly times, and we show this in the book, there are certainly times that historically have been better to be short VXX than other times. You're looking for the edges that are in place, quantify those edges during those times. We put that into the book. I think a major part of it, and I know that this is why I like your podcast so much, is you talk about risk control. Being short vol can be a dangerous game. We want to basically be able to go into positions. Ideally, one can do it with options to predetermine the dollar risk. So you say, if in fact the marketplace is right, this 1 out of X times that it's right, and vol does spike up, for example, as it did in February of this year, that at least you predetermine what your dollar risk was. If you're wrong, that was the worst that happened to you. What we don't, especially with any short position, is a concern of being the open-ended risk, but especially being short vol, this. You want to be able to protect, and that can be done with options.
So let's talk about this, because I think there's 2 points here which I really liked in the book, and that was this concept of, and you guys outlined it good because you showed, the performance metrics of, say, a lower scaling or non-scaling approach. And then you showed a scaling approach, right? As far as entry points and, adding to your position. I refer to it as laddering, but it's basically the same thing. It's, don't blow all your eggs in one, don't blow all your bullets in one shot, spread them out over time. And you guys use very much the same approach, which works out really well. So maybe just describe really quick that scaling component, and then we'll talk about covering risk.
Sure. So, we're pretty much style agnostic in a sense that, some people will and many people will put me in the camp of being a mean reversion trader, and, and other people will claim to be trend traders. What we're basically doing is we're looking for statistical edges in the marketplace. On a shorter term basis, where we see the statistical edges, a mean reversion. As far as anything in the equity markets, nothing we've seen reverts to the mean better than the S&P 500, SPY. Published that years ago, continue to update those same tests. They continue to show strong historical test results. When you get into volatility, it reverts to the mean even greater than SPY does. So when you're using a scaling approach, or as you call it, a laddering approach, it's essentially if volatility is going to revert to its mean, which basically means what comes up must come down, and vice versa. As it gets stretched, it's a rubber band. As you're scaling in, you're essentially scaling into more. VXX becomes more and more overbought. And what you're basically looking at is that on a historical basis, the large majority of the times, and some of the test results in the book are, they're well north of 90% of the time, within a few days, volatility reverts to its mean, meaning VXX ends up dropping in price. And if you're able to be there at the right time, some of those moves, when vol crushes occur, meaning vol comes in, those vol crushes are usually substantial.
Yeah. Yeah. And I think it's, what I liked about it is that, the way you guys outlined it was, say VXX goes up, you add 10% of what your position size would be. And so just to clarify on this, if you said, look, I'm going to allocate 5% of my account towards a VXX strategy whenever it comes about, right? Then you would do 10% of 5%, right? And then as VXX potentially hits the next level or closes above, the barrier that you laid out in the book, you add another 20% of your position, 30, 40, 50, etc. I think it just goes up to 40 actually. But then you continuously add to the position and basically average up is really what it comes down to, is you're averaging up as it's becoming more and more stretched, still within the confines of keeping the position small overall, but you're just adding to it.
Yes. And again, if you move it over into options, you can predetermine the dollar risk with that. And the upside of doing that is basically the more, in VXX cases, the higher it goes, the more overbought it becomes. That's just better pricing for you, at least on a historical basis. The ability, though, to be able to visit, downside to that is that sometimes the market only becomes a little bit overbought, meaning there's just a small flare-up on VXX, and sometimes VXX will rise, for example, ahead of a Fed report or whatever protection is going to be put into place from there. So you may not be able to get onto a full position. The position sizing comes in. But in the ideal world, you'd like to see multiple days of fear. And I think, I show this throughout the book, that the more days of fear that's in the marketplace, the better the edges become. I bring it back, into military terms, and I often like to think in military terms. View it as showing the people on the other side, they don't like losing money or day after day, or listening to stories where things are going to get worse and worse and worse. That's where it goes back on a behavioral basis, where they just say, I can't take the pain anymore. And that's where the edges start existing. That's the reality of the marketplace.
I love it. And I love it because, like the concept we try to teach people here, and this goes even back to not even necessarily VXX, but going back to all the back testing we've done on a bunch of different tickers and strategies. And that's when implied volatility is low, there's still an edge to be gained, but it's lower, right? And so your position size should reflect that. And when implied volatility scales up, when VXX goes up, you should increase your position size accordingly because the edge is greater. It's harder to do that. Believe me, it's this, and I know this too. It's hard to sell in the middle of, some of the stuff that might be challenging emotionally. Like, why am I doing this? Kind of playing the contrarian. But statistically, like you said, on the quant side, it works out really well.
Yes. And it is. It's one of the hardest things to do, especially, for example, again, not to pick on CNBC because, as a whole, they provide a good service. But if you're listening to CNBC during the day while this is going on, it only makes it harder.
You feel like the world's ending.
The rational part of your mind says, I don't need to be there for this trade. And those are usually the ones where where people are the hardest to trade, those are usually the ones that, on a look back basis, turn out to be the best trades.
Yeah, absolutely. The biggest opportunities. So, well, cool. All right. So let's change gears here a little bit on VXX. Then we'll move over to some other stuff. But on VXX, so let's use this as the example case study. We have VXX moving higher. Whatever the catalyst is, really ultimately doesn't matter because we're going to, ignore the news to some degree and, not worry about it. But let's say we start scaling into a position. But now let's think about how we might be able to do this with options. So I know you briefly touched on it in the book, but of course, naturally, I'm more interested in, hearing thoughts on how you would do it or how some other people have done it that you guys have, consulted for or worked with. How would you look at an option strategy for VXX or maybe multiple option strategies?
Okay, so the simplest and most efficient way to do it is deep in the money puts. If depending upon what you're looking for in the time frame, and usually based upon the strategy, we have two strategies in the VXX or the vol panics. Those are short-term holds, as you've seen from the historical test results. They hold it for a short period of time. We also have a VXX trend strategy, which holds on average, at least on a look-back basis, approximately 3 months. So you structure the trade based upon where you think potentially you're going to be holding, for how long you're going to be holding the position. But those deep in the money puts become a better way to be able to do that. The good thing about the market maker or the market makers in VXX is that they play. And I think this is a very important point. When you take a look at a lot of options out there, there are market makers that are just not willing to play. They'll have wide spreads. You put things in, you're not going to get filled. What we've seen over the years is the VXX market maker. He's there to play. He keeps, at least in my opinion, and this is as of today, he keeps an efficient market. They keep an efficient market. It's well done. You can get good fills. There's liquidity there. You can basically put on spreads if you want to do it. But to start at the most basic level, it's essentially a deep in the money put. Okay,
like a 70 delta, 80 delta put.
Yeah, I'm going higher, and you're going to go pretty deep in the money. I'm going to use just generic term. I'm going to use round numbers here. In 80 delta is good, and 90 delta is better. But in times of stress, you're going to be deep in the money. That's the drawback to be able to do that. One can then go further, and I know you teach this along the way, and I'll let you pick that up outside of this podcast. Ways to potentially bring in income, because most of the options, especially the out of the money options, are going to be spiked. The implied volatility is going to be spiked. So you can lessen the cost by doing certain things that are there. That's more for the intermediate and expert professional traders that are listening to this. On a most basic level, though, 80 delta or above, deep in the money put is potentially what you should be looking at.
And would you be, so holding periods, I think from the book, somewhere around 3 to 5 days, somewhere in there, maybe a little bit longer in some cases, but you would be looking at contracts that are that far out, or would you go just a little bit further out in timeline to make sure that you captured what you needed to have, as far as like make sure you traded within that window?
Usually, we're talking about now the vol panic strategy. So yes, the hold is on average, somewhere between 3 to 7 days. So if today, which it is, today is Thursday, but potentially be looking at next week's expiration.
So, and I think that gives a lot of people context. And what I love about options, and hey, look, you even said this, in there. So I'm going to quote you on this because I think it's a good quote, but you said it's the golden age of options. And it really is, because I don't know anybody who would truly go 100% naked on VXX. And if they did, I don't think they really understand the risk that's involved in that. I don't know why they wouldn't use something that has capped risk.
Yes.
Yeah. Okay, good. So we're on the same page there. All right, cool. So let's talk about let's change gears a little bit and talk about another one of the strategies kind of outlined, and that is the TPS strategy. So time, price, and I forget what the other one was. I have it in my notes. Scale. Yeah, time, price, and scale. So you guys did a lot of back testing on this, not only for SPY, but also for a lot of other liquid ETFs, which I like because I trade a lot of those. So kind of walk us through the thought process on this, because it's not a vol-focused strategy. We're not trading a volatility product like VXX, but we are trading the same, underlying concepts of fear and greed in the market. So how does this one work, and how can maybe people apply it?
It's essentially, as we just discussed with VXX, it's a scaling approach. We did the original research back this in 2008. The numbers when we first did it, somewhat blew us away. It looked too good to be true. We had to run it multiple times, and now, of course, it's a decade later, and we've continued to update the test results. But it's essentially taking advantage of two things on the long side. Number one, as ETFs become oversold, they're oftentimes becoming oversold for behavioral reasons. We used to believe many years ago, used to believe, well, these are the technicals. This is done. RSI was the 2-period, 3-period, 4-period RSI is the holy grail out there. It does a really good job of measuring things, how overbought and oversold are. But really what it's doing is it's measuring to a degree just how much fear is in the marketplace. Okay. The fear can be induced by an event where there's selling coming into place. The fear could also be just money managers pausing from buying. So, for example, if there's a big economic report coming out in a couple of days, or if the Fed is going to be making an announcement, or there's some sort of things going on, money managers will sit there and say, you know what, I'm going to pause. I don't need to make my decisions today. I'm going to wait until after the event. What happens is that that's in a sense of fear. Their fear of entering the market today versus entering the market when, quote unquote, the coast is clear after the event has passed. What the RSI will do is we'll find at certain levels as it gets into levels, we call them, into those buy zones, you start scaling into the positions, okay? And the position basically is, number one, the ETF is oversold. Number two, which is very important, that 200-day moving average plays a big, big role. I mentioned this throughout the book. Paul Tudor Jones, the great hedge fund legend, said it's a single favorite indicator. Markets, we ideally like to see equity ETFs above the 200-day moving average. There's a big difference, not only in behavior, the day-to-day movement and the upward bias that occurs above the 200-day moving average, but also in the volatility. Volatility substantially increases when markets are below, especially ETFs are below the 200-day moving average. We've quantified that. We've placed that into books. We just recently updated those test results. Someone sent me some things that went all the way back into the 70s that showed, multiple markets having increased volatility below the 200-day. So we like to be above the 200-day moving average.
Can I just jump in? Can I ask a question on this? And just as a clarification point, what you guys are using the 200-day moving average for is more of a judgment of trend, right? Versus, and it's not being used as an actual buy or sell signal unless it happens to cross, in which case it might, trigger a different style of trading.
Yes. So if you take the same test with and without a 200-day moving average, so let's say you take some indicator and say I'm using this indicator that's showing the market is oversold, okay? And then you have some sort of short-term exit, meaning a mean reversion exit that will exit within 3 to 5 days. That could be a moving average. It crosses above a short-term moving average. It has an RSI reading above a certain level. You'll see dramatically different test results when the markets were above the 200-day versus when they're below, okay? You'll not only see that the average gain per trade and the percent correct and the average gain per trade is greater when it's above the 200-day moving average, but when you take a look at the volatility, the day-to-day volatility of the movement, it's night and day. Markets get to be extremely, unpredictable below the 200-day moving average. It doesn't mean the prices are not going to go higher, but it's just a different regime. We use that 200-day to basically use it as a line, draw the line in the sand, saying, okay, is the market in a bull market or in an uptrend, or is the market in a bear market? Kirk, we published that back in 2002, updated those test results in 2007. We updated them in 2010. These are through various books and through our Trading Markets website. And as you can see here, I'm just updated again here in this book in 2018. It continues to hold.
Yeah, totally. And I like it. And I think, my thing is that you're not using the 200-day as the indicator to buy or sell. It's the indicator to see which, style of strategy and to maybe narrow it down. You're generally looking for buy type strategies when the stock or ETF is above the 200. And then you're generally looking for sell type strategies when it's below, and using the 200-day to decide which one you kind of are watching out for.
Yes.
Yep.
That's
okay.
correct. Yes.
Cool. So TPS, sorry, and I didn't want to ruin your train of thought, but I wanted to clarify and make sure that we're on the same page with, how you're looking at it and how you're using it. So, but you guys use TPS and backtested a lot of different case studies, which I think is really interesting on both SPY and other ETFs, other liquid ETFs. But the end result was that it works out pretty well, right? Is using these short-term RSIs and scaling into it. ends up being a decent strategy if you can continuously watch them.
Yeah, yes, and that's in the majority of equity ETFs. That's in the majority of equity ETFs, not only in the United States, but for those traders that like to use country funds. You also see the same type of behavior around the globe. I find that fascinating.
Yeah, that's fascinating. I agree with you because everyone thinks it's always, or that things are different other places, but they're not. that is fascinating, you know?
Right.
So here's a question I have, and I want to use the story that you kind of outlined in the book with Marko Kolanovic. And, you know, there was a time, I forget the date it was, but anyway, it was right before Brexit or right after Brexit. So we all went through Brexit, right? Everyone was anticipating the end of the world. And Marko published, I don't know if it was a white paper or just sent out a tweet or message or whatever, but basically said, you know, that he was fearful of what was going to go on. And during that exact time, you also got a buy signal using some of the layout of, you know, how you guys use your strategies. And this to me is interesting because, and I want you to go through this story and how it kind of all evolved, because this, I think, is what kills people all the time, is that they see the writing on the, like they see the technical signals, or let's call them the quant signals, the thing that they should do, but then their other side says, wait, maybe this time is different, right? And I think this was a great description in the book and that kind of story. So I want you to go through this story if you could.
Yeah, thank you. So Marko Kolanovic is one of the chief strategists, macro quantitative chief strategists over at JP Morgan. I state this in the book. I'll state this here. I have a tremendous amount of respect for him and his team. They do phenomenal work. They do high-level work on derivative markets and then how it affects the overall markets, okay? And as I stated in the book, being on the other side of their trades on a long-term basis is probably not the place you want to be, okay? A lot of hedge funds, a lot of trading desks really do follow their research. They're smart people, okay? But what it ultimately led to is he has a tremendous amount of influence. He has so much influence. He will move markets, and when he puts things out there, it tends to generate a lot of activity, not only in the media, but in the traditional media, but also on social media. So Brexit comes. It's pretty quiet. I showed this in the book that in the month of June, it's pretty quiet during the month of June. I believe it occurred on the first weekend of the official summer, which, as you know, you lived in the East Coast, you lived in New York City. That first summer, everyone clears out of New York City. They all head out to their vacation homes. And everything gets quieted down. The desks are probably being half filled on that day, and then Brexit hits. So there was this, out of nowhere, this massive hit to the market. And within a 2-day period of time, the market ends up losing between, I think it was on Thursday to the following Monday, and ends up losing 5% of its value. And in the low volatility environment, which very much was in for multiple years there, especially heading into into 2016, that was a big move. So there was panic. There was just outright panic in place. And then what happened was JP Morgan, through Marko Kolanovic, they put out a report. And I'm doing this by memory. I believe the report came out, though, after the close on Friday. And basically what they did was they did their analysis, which is always great analysis. And they showed that because of the level of short volatility positions that were out there and the amount of things that are going to trigger, that there was potentially $100 billion. And I'll say that again. There was $100 billion of selling that was going to come into the marketplace early the next week. So you now think about it. It's Friday. The market's closed. The market gets hit really hard. Brexit is every place. And now there's a report put out to be maybe arguably the best strategist and the best strategy team in all of Wall Street. And they're saying there's $100 billion of selling coming in, and it's going to hit the marketplace on Monday. So there's panic there that's in place. Depending upon which variable you use, there was potentially a buy signal there on Friday. Okay. But if the market is going to sell off on Monday, for sure, there's going to be a buy signal based upon the rules that we showed in the book. And as I state, that's a very tough emotional place to be.
Yeah, it's a predicament to be in. Yeah.
There's a couple of parts to it. There's this major sell-off. That report that he put out there went viral. It was on all the news networks, the major financial news networks, and then of course it was through on social media. It was seen everywhere. Monday morning was met with some serious selling, and I think that's where somewhere during the day on Monday the market had dropped as much as 5%. versus where it was on Thursday. There is a decision to be made over there with the knowledge that there is potentially a calamitous sell-off coming. Do you step in and take the buy? You're taking the other side, not only taking the other side of one of the smartest men on Wall Street and one of the smartest teams on Wall Street, but there's all these hedge funds, very bright, intelligent hedge funds that have a tremendous amount of money out there. And if they're following his advice, they're selling also. So you're buying from them. And that becomes a tough decision to make. But as I showed in the book, and, as we showed, as had occurred from the test dates, I believe, we showed the test date on there to show that from 2012 to 2017, those signals occurred 62 times on the test results. And 60 of those 62 times, including that time, they turned out to be profitable using the fixed rolls, profitable based upon the test results that were there. Those are tough trades to take. But as you could see from the move that occurred, the market bottomed out that Monday. Tuesday it rallied. Wednesday had a substantial rally, and there were exit signals given that Wednesday. Okay, you were able to buy from scared money, and that scared money could be coming in from multiple sources, but plus tied into the influence of a very powerful team there on Wall Street that created that opportunity to get advantageous pricing, which ultimately played itself out over the next 48 hours.
Yeah, I think it's fascinating. I mean, this to me is one of those great case studies that I will always refer back to because, whether, he was right or wrong, it's just, you can see visually in the charts and just even go back and look at the research. Like I typed it in the Google News. I mean, everybody had a news story on this, back during this time. Like you should see the news stories that people, because I was just looking, I was like, okay, let's see how, crazy people went. But people were going bananas about this. Everyone was talking about how Briggs was going to be so bad. And the end result that I always get back to is, and I thankfully have learned this lesson a long time ago being an analyst and knowing exactly what a company was going to do and seeing the market react differently, is that we have no freaking idea what's going to happen, right? And if it gets back down to what you talk about and what I talk about all the time is, just keep your position size small, manage it, and play the long-term game. This is a great case study and truly this maybe the smartest people or some of the smartest people on Wall Street, along with everybody else in the hedge fund industry, getting it completely wrong.
Yes. In that case, yes.
Yeah, I love it. Cool. So, all right. So let's switch gears here. And I think that's a great little synopsis of that. So thank you. And again, it's all in the book. We'll have a link on the show notes page. I think it's tradingmarkets.com/buythefear if you guys just want to go directly there. By the way, I get, just so there's public everything, I get no affiliate for any of this stuff. I'm truly promoting this. I don't want anything. So, I'm truly promoting this. And I think it's a good book that everyone should get. As far as let's talk now and kind of wrap things up a little bit with maybe some other high level questions that I think came out of the book a little bit, maybe weren't discussed as much as, needed to be in the book, but definitely is the continuation of that. So first thing is you talk about stops, and stops is a very interesting topic for me because what you said in the book was that, stops don't work if the markets go too fast, right? And it's hard to use stops as the end all be all risk management tool. So can you elaborate on that a little bit? Because we have very much the same opinion on stops.
Yeah. So I think a simple exercise for everyone listening to the podcast is just multiply the number of hours that the market is open, the U.S. equity markets are open, okay, times the number of days a week, and then take a look at the total hours that are in a week, and you'll see the majority of the time the market is closed, okay? So there's a lot of things that can happen, and I've been doing this now for many decades. So there's a lot of events that have occurred, world political events, economic events, that these things occur, and oftentimes if they occur when the market's closed, those stops don't do any good. So I know you cover this in an example. It's just simply a stock is trading, let's say, at $50 a share, and someone says, you know what, I'm only going to risk 10% on the position. I'm going to put my stop in at 45. All well and good, except that if something crazy happens overnight, and it doesn't need to be a world event, it could just simply be a corporate event. We see this happen, almost on a daily basis. Companies will come up with just, they'll miss earnings, and those will occur. And hypothetically, that stop opens up at 20. That stop at 45 does no one any good. Okay, yeah, and I will say, there are places for stops. Stops do play a role. So it's not just black and white. Don't use stops. Stops do play a role, but there are at least in my opinion, and Kirk, I know because I listen to your podcast. that in your opinion, also there are potentially better ways to protect positions, and whether it's done as a supplement or done by itself. And it's in my belief that options are a way to at least be able to get 24-hour a day, 7-day a week protection on your positions.
Yeah. Yeah. And I think it's cool. I think it's interesting because, you said it can happen on a corporate event, but what we've seen recently is that it's happening even in large ETFs. So case study would be RSX, I think was down 15% or 10% one day. EWZ last year was down, I think 20% in a single day. I mean, this stuff can happen so fast. So it's not just stocks, it's everything. And so, yeah, I think that there's a lot of things you put in place before you use a stop loss. I feel that too many people lean on stop loss as a crutch, and then they get mad when the inevitable happens, and they yell and scream at the market. So, all right, good. So let's round this thing out with a talk on automation. And we talked earlier before we hit record, but as you know, and as everyone else knows, we've been building out and have built out a completely automated platform. I think where this industry is going, and just to share some of the stuff here and kind of get your opinion on this, is that there's no doubt that automation is now let's say a force, or at least computerized trading to some degree. So I think there's a report from JP Morgan that said, just 10% of regular of trading right now is done by regular stock picking. Most of that is done on the retail level, the regular people like me and you. And then there's another report out, I think by Financial Times, that said 85% of trades right now are done by high frequency computers, only 16% done by actual human trading. So I'm curious to know what your thoughts are on not only just the future of where this business is going, but then how it applies to edges like this. Because if most of our edge right now is fear and greed and emotional behavior, where does that edge take us in the future as more and more trading becomes computerized?
Yes. So that ties into the systematic trading. So at the end of the day, if one is trading systematically, that's in a sense computerized trading. Okay, it's basically a set of rules. You can place that set of rules into your execution platform, and the trades get executed. So anyone that's basically using a rule-based approach and a quantitative approach is trading systematically, and arguably could be said, is a computer trader. They're not using discretion. It's basically the rules are in place, and that's what they're doing. The thing that fascinated me that when we were talking earlier was your discussion of basically, talking about moving the option trading into automation and being able to do that. I like where you're going with that. I think that makes a great deal of sense. There are, options. As you mentioned earlier, and as I mentioned in the book, this is the golden age of options, and it's only getting better and better and better. It's just I attend very few conferences now, but they're usually the higher level conferences, and one of them is the CBOE Annual Risk Management Conference. They do a phenomenal job. So the CBOE has basically moved from a place for speculators for a place for professional risk management, and they have a global approach. Okay, so they're going about looking at this on a global basis. If the CBOE continues to execute their business plan, options are just going to become larger and larger and larger. And the things that you're doing, for example, on the automation side, and being able to, if one wants to be able to say, okay, there's behavioral edges in place, I can quantify them, be able to put in, positions that are in place via the option markets and be able to do the execution and get clean execution. That's a great place to be. So I was, I didn't know you were doing that to the degree that, as you told me before we started here, and I'm excited for you, Kirk. I think there's great place that you're going with this.
Yeah, no, I think it's cool. And I appreciate that very much. And, I think it's an industry changer for us. I think it's a revolutionary thing because it's been in place in, the equity and Forex side and future side, but options are a different beast. I mean, they're, cubic, dimensional. And so that presents a different challenge. So again, just on my side, how do you see, let's say, the fear greed edge, though, evolving as more people just computerize trade anyway? Or do you think that it's going to change shape? Maybe it's not as, I don't know, maybe it's not the same style as it is today or in the future. How do you see that edge evolving with more computerized trading?
This is my opinion, and again, I've got to be careful of making a forward-looking statement. So I'm just going to state that fear and greed is inherent It has been there for centuries. We see it here, today. Computer trading is not new. As you know, high frequency trading began back in the late 90s. Most people don't know that. The media tries to make it sound like it just happened in the last couple of years. The computers have taken over. I was reading in the late 90s that the computers have taken over. If you take a look at the strategies, and as we look forward, when you take a look on a behavioral basis, those behavioral bases have remained in place. And as long as humans are involved in this, and there's another, I'll bring up, one more point, which I didn't put so much in the book, but we can mention here. Most money management firms are basically, a lot of decision making is being done by the risk managers who basically oversee the portfolio managers. Okay, and you probably know this back from your days working in the street, working directly in the street. Those risk managers carry a lot of power. And as much as the money managers may have conviction, say, you know what, I'm going to stick in here, the risk managers are there to protect the enterprise.
They're like, no, you're not. You're not jumping off the ledge.
That's exactly it. Blow them out. They just blow them out of the positions.
Yep. No, I think it's true. I think about my kids jumping off the couch, whether they think they're going to land or not, I'm stepping in to say, you're not doing it. Yeah. You're going to break your leg. No, I think, my thought on this, cause I know people are going to ask all the time, is that as more computers come online and as more people start to just program their strategies versus click their strategies, the same fundamentals of not wanting to lose are going to be programmed into the market. So that's the way I think about it is, whether somebody, decides to do this on a clicking basis or whether they program into their fund or their quant fund, hey, if the market goes down by X% or this goes down by whatever metric, we want to step in and buy insurance, or we want to step in and liquidate this position in favor of that. And I think that everyone has different trajectories. So what you still have is essentially the same dynamics that are driving the market. It's just the triggers that they're using are completely different.
Yes. I 100% agree with you, Kirk.
Cool. Wonderful. Well, good, man. Hey, I appreciate your time. Thank you so much for being here. Like I said in the intro, it's really truly a pleasure for me to have you on the show and, kind of talk about this stuff. I think me and you are very much in a line, which is good. And that's why I don't bring too many people on the podcast, because I think having people who have the same thought process and lines of thinking are really, really important. And not that I don't want different people's lines of thinking, but it's always easier when we generally tend to agree. So as always, if you guys want to learn more about the book that Larry put together, you can head on over to the show notes page on Option Alpha, or just go directly to tradingmarkets.com/buythefear. We'll put links in all the show notes for you guys. But again, Larry, thank you so much for tuning in today. If everyone wants to get in touch with you,
thank you.
Yeah, if everyone wants to get in touch with you or wants to learn more about you, how can they do that?
Go to the Trading Markets website. I put out a 2 to 3 times a week research letter, and that's free. They're able to do that. My books are available on Trading Markets website. They're available on Amazon. Anyone wants to email me, feel free to email me. It's lconnors@cg3.com. I'm not in front of my email all day, so sometimes it may take a day or two to get a response, but I do my best to answer all the emails so they can do that. And Kirk, thank you for this, Kirk. Your podcast really is tremendous. I listen to a select few podcasts in different industries. In our industry, I feel yours is the best out there. So
awesome.
Thank
I appreciate
you for having me on here today.
Thank you.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.